My name's Ethan Braid. Today we're going to talk about how much federal tax you pay for $150,000 of retirement income. This is going to be a very helpful tax planning and retirement planning video for those of you who are trying to get a handle on how much tax you are going to pay at the federal level for your retirement income stream. I'm going to show you several different scenarios ranging from tax-free to low tax, middle tax, and high tax on a $150,000 retirement income stream. After you watch this video, you'll have a much better grasp of how much of your retirement income you'll be able to keep after you pay taxes to the federal government. Here is a high-level summary of 5 different scenarios that we are going to review for a couple that is married filing joint, 65 years or older. Notice that in all scenarios, income is the same, $150,000, but the amount of taxes that we're paying ranges from $14,000 to 0, meaning that your taxes on $150,000, depending upon the character of the income, i.e. Social Security, IRA distribution, qualified dividend, Roth IRA, etc., the tax can range anywhere from 14 to 0 if you have a $60,000 Social Security base and then start changing these other variables. For example, if you only have Roth IRA and Social Security income and retirement, you won't have any federal income taxes to pay. But notice what happens as we start increasing the amount that this couple is receiving from an IRA distribution, ordinary dividends, rental income, interest, etc. As that number starts going up, so do the taxes. They go up and up as well. And notice also that if we start to increase qualified dividend income as we go left to right and increase the qualified dividend income, look at the taxes going down. So right away you can see that for the average couple receiving $60,000 a year of Social Security and $150,000 a year of total retirement income, their federal tax bill could range anywhere from 0 to over $14,000 a year. And that federal tax bill is going to be determined by the character of the income outside Social Security. What is the amount coming from rent, in ordinary dividends, or an IRA distribution versus qualified dividends or a Roth IRA? Now let's take a look at some of these scenarios in a little bit deeper detail so that you can see how changing the character of the income that you're receiving in retirement will affect your tax bill. Our first illustration will be the high tax example where this couple pays $14,020 in federal tax on their $150,000 retirement income stream. They're receiving $60,000 of Social Security and $90,000 from rental income, IRA distribution, annuity income, etc. It's all taxed the same way, ordinary income. Receiving this $90,000 of income in addition to Social Security causes most of their Social Security to become taxable. You can see that Social Security income subject to taxation is $51,000. They receive their standard deduction and their taxable income is going to be $108,700. This is an effective tax rate of 9.3% on their $150,000 retirement income stream. In our second illustration for this couple, notice that the federal income tax bill has gone down by 20%. How do we do it? We change the character of the income. Instead of receiving $90,000 on this line right here in an IRA distribution, annuity income, rental income, etc., we're only receiving $60,000. And we've added in $30,000 of qualified dividends. The end result is that our federal income tax bill is going to be 20% lower, and that is because $15,350 of the qualified dividends are going to be taxed at 0%, and $14,650 will be at 15%. In our third example, we've reduced our federal income tax bill nearly 50%. All we did was increase qualified dividends to $60,000 and decreased rental income, IRA distribution, annuity income, etc. to $30,000. The end result is a big decrease in our tax bill. It saves us almost $536 a month versus the high tax scenario. Notice also that $45,350 of our dividends are going to be taxed at 0. $14,650 will be taxed at 15%. End result is our effective tax rate is now 5.1% on our $150,000 retirement income stream. This illustration is our low federal income tax scenario. The couple is now receiving only qualified dividends of $90,000 and Social Security of $60,000. The end result is that $75,350 will be taxed at 0%. These are qualified dividends, and the remaining dividends of $14,650 will be taxed at 15%. Ultimately, we're bringing the tax bill down by roughly 70%, again, by just changing the nature and character of the income stream in retirement. Now that we've reviewed all 5 of those tax illustrations, let's go back to the summary page, take a look at it, and think about how a couple planning for a $150,000 retirement income stream might go about organizing their investments to keep their taxes low. Looking at this summary page, it becomes very obvious that if you are building wealth in rentals, limited partnerships that provide K-1 income, annuities or IRAs, then you're going to be in the highest tax scenario. Most people will want to try to lower their taxes in retirement so they have more money to spend. So how do you get there? You need tax diversification and good tax planning. When it comes to investing and building your wealth, make sure that you're including investments that pay qualified dividends in your portfolio and consider using a Roth IRA. Those investment structures will help lower your tax bill and give you more money to spend in your retirement. Integrating tax planning with your retirement planning and your investment strategy can put a lot more money in your pocket throughout the course of your retirement. For example, if you could reduce your federal income tax bill by just $600 a month, that would save you $7,200 a year. And over the course of a 25-year retirement, you would have an extra $180,000 to spend. It really adds up over time. So when it comes to your retirement planning, you want to be sure that you include tax diversification strategies as part of your retirement plan. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.